Blended families are becoming more and more common, and yet much of traditional financial planning still assumes a first marriage with children from only that marriage. That's not how many modern families function today. When you're remarried, when you have children from previous relationships, when stepchildren or former spouses remain part of the equation, your financial life naturally becomes more layered. And when planning doesn't reflect that reality, it can create challenges. Not just financial challenges, relationship challenges. At White Oak Planning, we often say that blended families don't need more complexity, they need more clarity around the complexity that already exists so that they gain confidence in their current and evolving structure. Today, Jerry and I want to walk you through some of the hidden risks blended families face. What can one do, Jerry, to manage these hidden risks thoughtfully?
First thing to understand about blended families is this. Your beneficiary designations typically control where certain assets go. Yes, even if your will says something different. Here's why. Your 401k, IRA, life insurance policies, and many accounts with payable on death or transfer on death designations pass according to a contract, the beneficiary form, rather than through your will. So imagine this. You remarried 5 years ago, you updated your will to reflect your new family, but you never updated the beneficiary on your 401k. If you pass away, who will the money go to? That account will generally go to whoever you listed on that beneficiary form, even if that's an ex-spouse decades ago. We see this more often than people expect, and it's one of the most preventable mistakes blended families make. So here's a simple action step for you. Pull out every retirement account, life insurance policy, and account with beneficiary designations and verify who is listed. If it doesn't reflect your intentions as of today, update it.
And that's a huge risk, Jerry. Most people, including me, would be mortified if the 401k went to a prior spouse. Part of the thinking upon your passing is your 401k would go to your current family. But what if that wasn't the case? You and your current spouse decide to circle your wagons and build a new life together. Congratulations. That takes courage. Now, the question I would ask you to ask yourself is this. Let's say you have yet to update your 401k beneficiary to catch up with your new life. What kind of impact would that have on your current family's daily life and future if something happened to you yesterday? The second big risk blended families face is what we call the yours, mine, and ours dynamic. In blended families, there are often three categories of assets. Money you brought into the marriage, money your spouse brought into the marriage, and assets built together afterward. And very often, spouses have different expectations about how those categories should be treated long term. Maybe you feel strongly that the money you brought into the marriage should go to your biological children, and your spouse feels the same way about their money going to theirs, and that's completely understandable. But if those expectations haven't been explicitly discussed, if everyone assumes they're on the same page or altogether avoids the conversation, you're relying on assumptions rather than structure. When one spouse passes away, assets that transfer outright to the surviving spouse are typically under their full control. Over time, that can unintentionally change how assets are distributed. And biological children from a previous relationship may be left out. And not because anyone intended harm, but because the plan didn't fully reflect the complexity of the family. Many parents are trying to balance two deeply important priorities at the same time, caring for the partner they've chosen now, while also honoring the responsibilities they feel toward children from earlier chapters of life. And that tension is normal. Planning well isn't about choosing one relationship over another. It's about creating clarity so both can be honored.
That brings us to one of the planning tools often used in blended family situations, a Q-tip trust. Q-tip stands for Qualified Terminal Interest Property Trust. In plain language, it can allow you to provide for a surviving spouse while also preserving assets for children from a previous marriage. Typically, assets go into a trust when you pass away. The surviving spouse receives income from the trust during their lifetime, and when they pass away, the remaining assets go to beneficiaries you've already defined, such as your biological children. It's a way to support your spouse while also creating long-term clarity about where your assets ultimately go. Not the right solution for every blended family, but it's an important conversation to have because without intentional structure, you may be relying on goodwill instead of clear planning.
Another layer of complexity for blended families shows up in retirement spending decisions. This is one of the most emotionally loaded areas of financial planning. Let's say one spouse wants to help an adult child with a home purchase, maybe $50,000 or $100,000. If that gift comes from joint retirement assets, it affects both partners' financial security. And if one side of the family receives more support, or spouses feel different levels of obligation towards stepchildren, it can create real tension. There isn't a universal right answer here, but there does need to be clarity. What are you comfortable helping with? How do we define fairness, even if it isn't perfectly equal? How do we make decisions together before emotions run high? These conversations are easier when they happen proactively, not reactively.
Let's talk about life insurance, because for many blended families, it can be one of the more straightforward planning tools. When structured properly, life insurance can pass outside probate and go directly to named beneficiaries. For parents who want to ensure children from a previous marriage are protected, this can create a clearly defined pool of assets specifically for them. It's not a replacement for comprehensive estate planning, but it can be a powerful complement to it.
Here's what we want you to take away from this. Blended families don't have more problems. They simply have more layers. And when planning reflects those layers intentionally, families often experience more clarity, not more stress. The good news is that with the right structure, updated beneficiaries, clear agreements, thoughtful trust planning, and strategic use of tools like life insurance, you can create a plan that works for the family you have today. Not someone else's template, yours. And at White Oak Planning, our role isn't just to manage numbers. It's to help create alignment between people, priorities, and long-term intentions so that financial decisions support relationships rather than strain them.
Blended families are wonderful and they're complex, but complex doesn't mean unmanageable. It just means your plan should be built intentionally for the life you're actually living. And when you do that, you're not just protecting assets, you're protecting relationships too.